In this video, I'm going to share with you 3 ASX tech stocks to watch in 2021 that I think will outperform the market, and also let you know what price I'm willing to buy them at. But first, let's roll the intro. So I've been keeping an eye lately on the tech-heavy NASDAQ on the US market, which has consistently outperformed the more traditional stocks on the New York Stock Exchange. And I thought it was way overdue for some Aussie stock to also follow suit. Now, tech stocks can vary from financial tech to biotech, you got software tech and hardware tech. So the best way to actually get exposure to tech stocks is to put it in an index fund called XTX, which is a technology index fund on the ASX. XTX has actually performed so well that it's actually doubled the market return when compared to the ASX 200. So that's it, right? Invest in XTX and thanks for watching. Of course not. So while it's perfectly okay to invest in the technology index and then forget about it, I think we can do better and pick out the high performers to get an even better return. So these are my picks for the software techs of the year, and I'll follow up on more videos of other categories like the fintech and the biotechs, so make sure you subscribe so you don't miss any of those ones as well. Also, just before I start, just a reminder that this is not financial advice, as I haven't considered your personal situation, and this is more of a general information only. Okay, let's get started. The first stock on my list is the analytics and intelligence software company called Nuix. They take unstructured data like company emails and documents and text messages and anything that's digital really, and applies their IP to make it structured and searchable. Basically turns any random dump of data into a Googleable data source. This is not only valuable to big public companies to organize their massively huge data sources, but also to government organizations around the world when they want to investigate financial crime, data breaches, or tax fraud investigations as well. So think of something like the recent Royal Commission into the misconduct in the banking and you know what I mean. Nuix were heavily involved in that and would have been paid very generously. I think that as companies go more and more digital with more and more people working from home, they'll end up with data growing exponentially, and it really increases the need for Nuix to get involved in the affairs of businesses. Let's take a look at their financials. From 2014 to 2016, their EBITDA looks very strong and consistent. There's a bit of dip in 2017, but that's only a 10% decline, so it's nothing to worry about. Plus, their revenue for the year has actually grown a bit, so it's more likely that there's some one-off expense for that year. And in 2018, they do recover their EBITDA figure again. For 2019 and 2020, we need to go into their most recent annual report. And here we can see that they had a pretty blockbuster year in sales, with a 67% increase in EBITDA, probably helped by the Royal Commission into the banking industry payments starting to flow through. But what is most interesting is that in 2020, even though their EBITDA had increased by 78%, their NPAT, or their net profits after tax, rocketed by 217%. How's that even possible? If we go down to this table, it shows how they went from the EBITDA figure to the net profits figure. There's the interest income and expense, which is related to their debt, and not much changes here. The income tax expense is a proportion of the net profits for the year. So it's the depreciation and amortization figure that has barely moved, even though their EBITDA has almost doubled. Depreciation and amortization is a declining value of any assets that they own. Now, if we go down to their asset statement, we get a better view of why. Depreciation affects physical property and equipment, of which Nuix has barely any when you compare it to their huge intangible assets. Intangible assets are basically anything that can't be touched, like a logo or branding, or in Nuix's case, their intellectual property. So this basically tells me that their operations are very scalable and that they don't need to increase their expenditure to increase their revenue as well. Which kind of makes sense because they would just run their software IP over and over again, just on different projects, without needing to buy too many new things. Nuix IPO'd in December 2020 and has a majority shareholder Macquarie Bank who sold down their holdings during the float. They had an IPO price of $5.31, but at the time of recording this video, they are trading at more than double that. This gives them a PE ratio of almost 100 times, which is pretty crazy. So even though they are a solid company, I'd like to see their PE ratios come down a bit before I buy them. I'd probably be more comfortable buying them at around $8 per share or so. But I'm very conscious that it could very well get away from me in share price, so it's gone on the watch list so I can buy it on dip. The second stock on my list is the PCB software design company Altium. Its product, Altium Designer, is the most comprehensive and widely used by professional engineers and designers worldwide to make electronic products, and probably including the one that you're using right now to watch this video. It's also the most expensive piece of software in the industry, but most big companies are happy to pay for it because it's such an essential piece of software. With the global shutdown over the pandemic, Altium has had a drop in business growth, and that's reflected in its share price. Note that I said business growth. So even though growth has slowed down, its sales didn't go backwards at all. So as the vaccine starts to flow through, all the sales they didn't get will be pent up, and I think they'll get a big growth spurt this financial year. Let's look at their financials. They put in a nice graphical view of this, so let's analyze this. From 2014 to 2017, their revenue grew by 15, 13, 17, and 18%, so it's all in the teens. And the share price then started from around $2.50 all the way to $8. 2018 and 2019 saw its revenue and EBITDA increase by the 20s, and we got some pretty crazy movements in the share price. You'd think that a 20% increase in earnings will give a 30, maybe 40% increase in the share price, or maybe even 50 if you're bullish on it, but no, the share price decided to double instead. Same thing happened in 2019. It doubled again on a 23% increase in earnings. So I think it was in a bit of a bubble near the back end of 2019. In 2020, even with the pandemic, Altium managed to get 10% growth in earnings, but the share price has so far dipped by 10% instead. So the 2020 correction was actually much needed, and it brought it back down to more reasonable levels. For my price target, if I follow a more reasonable growth rate based on Altium's earnings growth, I'd be very comfortable to buy the share at $25 each, with the view that they continue to dominate the industry. But then if we have a look at their customers, you can see that they are all big, well-known players in the tech world who will constantly need to design and develop new electronic products, and I think Altium will always be the software of choice to use. So with this bullish view of their future prospects, I do think that anything under $30 per share will still be a very good long-term purchase. But if you're watching this much later, the company could be in a different position and my price target might not be the same. The third and final tech stock on my list is a data solutions company, Appen. There's a lot of buzzwords used in the company profile of Appen like machine learning and artificial intelligence, which are very generic and don't really explain anything. But the shortest and easiest way to understand what Appen does is that they take data that machines and computers don't understand easily, for example like an image or a video, and give it a caption or what they call annotation in the form of a metadata, which is just a label embedded within the data itself. So if we see a picture of a car, our brains would know it's a car, no matter what angle we look at it. But for a computer to recognize that it's a car, it would need to work out the overall outline, match it with its known outlines in its database, and then recognize it's a car. But then what if it's a little bit blurry? Well, we'd still have no issues knowing that it's a car, but the computer would suddenly get confused, and that's where Appen would come in. With over 1 million contracted workers around the world, humans would just annotate what they see and tell the computer so it can sort and categorize it in its database, so that other big tech companies like Google or Facebook will be able to show this in its search engine when someone searches for car. So that's an extremely cut down version of what they do, but let's just dive into their financials, which we as investors are most interested in. From FY18 to FY19, they've had a 47% increase in revenue and a 29% increase in EBITDA from 68 million to 88 million. This reflected in their share price, which also jumped by a similar proportion. The full year results for FY20 isn't out yet, but they've released a trading update to revise their earning guidance to be in the range of 106 million to 108 million, which is a little lower than previously advised, but will still be an increase of about 20%. But the market wasn't too happy about this guidance and the share price took a hit after this update. I do think it's a bit of an overreaction though, and the drop in price for Appen is more of a temporary disruption rather than a long-term shock, and I think their earnings growth will bounce back again. And generally speaking, if earnings increase, so does the share price. I do think that the current price of $23 per share is very fair and would be a great long-term hold into the future. So that's the 3 software tech stocks on the ASX that I think will outperform in 2021. Now, even though all 3 are really great stocks, I personally don't have enough funds to invest in all of them. So I'll be closely watching their share price in the coming months to see which one is best value for their money based on the company performance for the year. So what do you think about these 3 stocks? Do you already own them or now interested enough to look more into them? Let me know in the comments down below and hit the like button if this was helpful for you. I'll be coming out with more tech stocks in the upcoming videos, so make sure you subscribe so you don't miss those as well. Until then, I'll see you in the next video.